Good morning, everyone. Thank you for joining us. We will give it just a few seconds while people join the room, and then we will begin momentarily. Panelists, I'll ask if you could just please mute yourselves while we get through the intros, and then we'll kick it over to you. Great, let's begin. Thank you all for joining us. Again, my name is Lena. I'm Director of Operations at Opus Connect. We have a great panel lined up for you today. We'll be discussing if capital is sitting on the sidelines or eager to get to work during this time. So looking forward to getting to that discussion. But before we do, we have a few housekeeping things that we'd like to get through. First and foremost, Opus Connect, we are a lower middle and middle market M&A focused organization. We have members in fields of private equity, investment banking, lending, independent sponsors. We're membership based. We have chapters in LA, Chicago, and New York, where we do monthly seminars, typically in person. And in addition to those monthly seminars, we do deal sourcing events all around the nation. So if you're interested in learning just a little bit more about Opus Connect, feel free to reach out to my colleague, Jacob Zeffrin. His contact information is below there on the screen, and he'll be more than happy to answer any questions you might have. These events, we have live Q&A. So our panel will be taking Q&A. If you look at the bottom of your screen, there's a little Q&A bubble. That's where you'll type in your answers. Our moderator will be monitoring those, and we'll try to get to those as many as we can. So as they come to mind, feel free to put them there, and we'll try to answer those. These webinars, of course, would not be possible without the support of our sponsors. So I want to give each of them, if they are here, the opportunity to say a few words. We're going to start with NFP here, and I see Duncan in here. Duncan, please go ahead and introduce yourself and your firm.
Can you hear me?
Yep.
All right, great. Hi, everyone. This is Duncan Cummings with NFP. Thank you all for joining the presentation today. We're happy to be sponsoring Opus, and we're grateful for all the work they're doing to support the PE industry. As a general overview, NFP is a global insurance broker and consultant providing a full suite of insurance solutions to our clients. Our business has been and still is built on the back of private equity. So we have a deep understanding of the challenges and strategies that PE firms face. We work in a due diligence capacity, one-off consulting, brokerage work, and cross-portfolio aggregation, as well as transactional insurance products like rep and warranty. So if you're interested or any of those topics are interesting for you or your portfolio companies, please let me know. Thanks again, Lena and the rest of the team at Opus, and enjoy the presentation.
Thank you, Duncan. Let's move on to 4 Degrees. I don't believe Ablorde is in the room, but their relationship and deal flow management system for private markets. They are a newer sponsor. We want to thank them for their support. Moving on, Focus Search Partners, Steve Finder. I don't believe he is in here either. If you are in here, raise your hand, Steve. Focus Search Partners, a little bit more about them here, his contact information below. Please feel free to reach out if you have questions. Resourcive, Nick, are you in here? Nick Cressy is not in here, but they're a consulting firm and a newer sponsor as well. So grateful for their support. We'll move on. Last but not least is Lowenstein Sandler. And before we introduce them, we actually have Steve, who's moderating today. So I'll wait until we introduce the panel before I allow him to introduce the firm. We do have 2 poll questions just before we get to today's discussion that we'd like to ask of you all. So please, participate and submit your answers, and we'll try to move through this quickly, and then we'll go from there. So we want to know how you heard about today's event. We'll give it just a few more seconds, and then we'll share the results briefly. It looks like most of you heard from us, so great. The team is doing their job. A few from our sponsors, thank you for your support. Before we get to the second poll question, I want to go back to Resourcive. I see that Kathy is in here. Kathy, do you want to introduce yourself and your firm? And Marisol, if you could go back to their slide just briefly.
Oh, great. Thank you so much. I appreciate it. So can you hear me now?
Yes.
Oh, perfect. So I am actually filling in for Nick Cressy today. I am the Director of Strategic Partnerships at Resourcive. I've been here for about 6 years, and we focus primarily on the private equity space. So Resourcive is a consulting firm that works to support the portfolio companies in the areas of telecommunications and IT networking. So voice, data, internet, conference calling, video conferencing, data centers, contact centers, wireless, all of that falls under our purview. And in most cases, we're able to reduce costs anywhere between 30 and 55%. But we're not just a cost reduction firm. We're also an extension of the portfolio company's IT team, who is not on their payroll. So that's really important to know. We are a no out-of-pocket cost consulting firm that supports the IT team in many areas. But most recently, our clients have been using us for a 2-week diagnostic review, which actually looks at a month of billing and contracts. And in 14 days, we turn around a summary that shows them their total spend across all the carriers. We help them understand how early termination fees play into the matters moving forward. We provide recommendations on flexible options that might be available to them as they're coming out of COVID. As we all know, they're all trepidatious about standing new locations up. And in most cases, most importantly, in 14 days, we use our benchmarking data to show them the amount of savings that we can find that they can confidently use in planning to determine if they have capital to reallocate to other IT initiatives that are really costly, like cybersecurity or improving their technology stack.
Great. Thank you so much, Kathy.
Thank you for coming back. I appreciate it.
Absolutely. And then really quick, Rod Austin from 4 Degrees, if we can navigate back to that slide. Rod, do you want to introduce yourself and your firm?
Yeah, sure. Thanks for making the time. I am Rod Austin, head of marketing for 4 Degrees. We're a software company that provides a platform that helps with deal flow and relationship intelligence for private markets. So that includes private equity, mergers and acquisitions, investment banking, VCs, et cetera. Our platform combines automation to eliminate data entry about your team's relationship network with actionable intelligence to leverage it to your advantage. We automatically track your relationship network and your team's interactions with them to help you find the best relationship and the strongest path into companies. We feature recurring reminders to engage key deal flow sources, including bankers, sponsors, lenders, and service providers. And when you're traveling, as we start to travel more, we send you a list of relationships in your destination so that you can make in-person connections with those folks and help move deals forward. Happy to be here. Thanks for putting this on, Opus, and visit 4degrees.ai for more information.
Thank you, Rod. Okay, last poll question before we begin. We want to know who you are. This is helpful for us at Opus to understand who's joining, but also for the panelists to understand who they're speaking to today. So please submit your answers. We'll review them quickly, and then we will get to the main event. Okay, let's share those results so everyone can take a look. A lot of investment bankers, which is great, 32%. Independent sponsors, excuse me, 19%. Service providers, capital providers on both the debt and equity side. So thank you. I'm sure many of you are participating in our Deal Connect afterwards. But without further ado, I'd like to introduce Steve Siesser of Lowenstein Sandler. He's going to be our moderator today. Steve, I'm going to bow out and hand it over to you, sir. So please take it away. You're still muted, unfortunately. There we go.
All right. Technical difficulties. Well, good morning, everybody, and thank you, Lena, and thank you to all the sponsors. I think we'd all prefer that we'd be greeting you in our office in New York, like we usually do for these events, but under the circumstances, Zoom seems to be working just fine. So a little bit about Lowenstein, for those of you who don't know us, we're about 350 lawyers based in New York with offices across the country. We primarily work with funds and public and private companies and high net worth individuals, mostly doing transactional work across asset classes, as well as capital raising, investment management, and bankruptcy also is one of our most active areas. We're one of the top ranked bankruptcy practices in the U.S., as well as venture, securities litigation, a number of other areas. But primarily, we're transactionally oriented. And so I would usually say, when I look around the room, there's a lot of people I recognize, but given the environment, a little harder to do that right now. So today we have an interesting panel with some very active market participants, which we'll get to in just a moment. And we're going to be talking about basically how COVID has affected the M&A process. COVID clearly has affected everyone across the globe. I think there's degrees of impact. You know, for some, the impact has been positive if you're a manufacturer of hand sanitizer or a mask producer, for example. But for most businesses, the impact is discernibly negative. M&A is not different. We haven't been singled out. For the most part, while some deals are still getting done, deal volume is definitely down. But processes, sale processes do continue. I think there was a lot of runoff from the pre-COVID era. But there are still new launches happening during the COVID era. And today what we're going to do on this panel is explore the impact of COVID on those processes, specifically in the context of how bankers, buyers, sellers, and lenders are adapting to the changes imposed by COVID and how that's impacted deal terms and valuations, and then conclude with what we think the outlook is. So I'd like to start off by introducing the panel. I'll start with David. Or want to say a couple of words about yourself, David?
Yeah. Hey, thanks so much for having me on. So I am a managing director at a firm called Innovation Advisors, which is a boutique TMT-focused investment and merchant bank, and I lead our fintech efforts globally.
Thank you, David. How about switching to Peter?
Sure. This is Peter Ryder with RFE Investment Partners. We're a lower middle market private equity firm, currently investing out of our 9th pool of capital, $250 million of institutional capital plus another 175 of SBA capital. So we invest both the mezzanine and the equity in our transactions. Focus, in companies, broad range, but predominantly manufacturing and services, pretty broadly defined.
Thank you. James?
Good morning. Thank you, Steve. James Rybakoff, CEO of Aiken Bay, 30-year-old investment bank. We focus 50% of our resources towards M&A, buy and sell side, cover mostly private equity funds, but also strategics. The other side is raising debt capital and private placements of equity. Deal size, EBITDA, $8 million to about $25 million in size, and focus on trends, interesting deal flow that I think is a little different from the market and definitely complicated transactions.
Great, thank you. And last, but certainly not least, is Scott.
Good morning, everybody. I'm a managing director of BRIGHTWOOD Capital. We have around $5 billion of assets under management. primarily a debt lender, and the bread and butter is really the Unitron senior stretch loans. However, we do have pockets for second lien, mezzanine, and equity co-invest as well. In deal size from an EBITDA perspective, call it 8 to 25 million. We can go higher, but that's probably the sweet spot. And in terms of check size, really could be anywhere from 20 to well over $100 million. Industry focus, we could separate the world into transportation, logistics, tech, telecom services, healthcare services, business services, which is obviously the catch-all, and then franchising, which is a bit of an outlier given the more B2B focus, but it's something we do a lot about as well.
Great, thank you. Thanks, everybody. Well, why don't we start off today? Let's start talking about the parties' approach to deal processes in this new normal world we're living in. David, I'll throw the first question to you. How have you seen buyer behavioral changes? How has the buyer's behaviors changed so far the last couple of months?
Yeah, sure. So I think my experience seems to be a little bit different from what other folks have been seeing, which is not much. We've seen, and perhaps that's because fintech is not nearly as impacted as something like real estate or consumer. But for the most part, the fintech buyers are not out there looking for bargains. They're paying relatively full price. They're happy to continue to proceed down deal processes. They're reaching out to me on a regular basis, the guys I know, saying, hey, do you have anything for me? Do you have anything for me? And I know I'm sure that I'm seeing things a little bit differently, but I've just been a little bit more surprised that folks are it's business as usual, more or less, outside of the fact that you can't really have in-person meetings. But we're even seeing some buyers that are more than happy to close a deal without meeting in person. So
let's talk about that, because I'm in the middle of a couple of processes right now. In fact, final bids are due next week, and we're expecting, there were not in-person management meetings. They were conducted just like we're doing this webinar, and the handful of bidders that are in the final round, they're prepared to sign up a purchase agreement and close the deal. And this is, about $150 million deal without actually having ever met management in person or visited. Now, it's somewhat of a technology infrastructure company, so it's not like there's a manufacturing plant, but still. I throw it out to Peter. What do you think? What are you seeing in terms of, given the impact of COVID, how are lack of travel and social distancing, how are those affecting the deal process?
I think for us, we're seeing, kind of a broad range of changes, but, probably not as much as I would have expected. A lot of the advisors that, were still, pushing or pursuing, kind of a process early in the life of COVID back in, early April, May, we're still kind of looking at, kind of a standard, kind of distribute a teaser, submit an IOI, and then kind of, what they kind of did was an interim step and said, look, we're going to, have a 30-minute conversation with management, open up the data room, and then, have more fulsome management presentations, once restrictions lift and everything else. So, they're, in the process now of, starting to kind of arrange those visits. I would have thought, that, some of the advisors, kind of may look at this as an opportunity to kind of reset, kind of how we think about processes given, kind of the distancing measures. So I'd be curious to hear from, kind of the others on the call. But, our biggest kind of determining factor in terms of where we are in an IOI value range is, kind of our perception of management. And, is there a way to, kind of get earlier access to management through, kind of a pre-taped, 30, 45 minute, kind of, scripted call that kind of lets them walk through the business, the key, kind of growth drivers and allow, kind of, the participants an earlier look at kind of the team. So curious as to kind of what others are seeing. I haven't seen a big change other than just kind of a lengthening of the process at this point in time.
Thanks. Scott, what are you seeing in terms of what effects, what effects on process the current situation having?
Yeah, it's an interesting question, and I think it does vary quite a bit by industry, which it sounds like everybody else is experiencing as well. We were just in the middle of a deal for an electronics manufacturing company. Very good company, diverse end markets. And the deal actually started pre-COVID, then went on pause during COVID. The company was able to manage pretty well through COVID. Obviously, some end markets, automotive and film projectors and whatnot, started to suffer significantly. But the management team is quite agile and was able to secure new contracts for ventilators and other things that actually made the 2020 projection for the standalone business significantly higher than it was pre-COVID. Nevertheless, and there's some other elements of the deal, but nevertheless, midway through the deal, the buyer, who we'd been working with very closely, putting together a syndicate of banks to fill out the group, and it was going to be an acquisitive strategy, et cetera, put the process on pause. And the stated reason was, uncertainty and decline in certain end markets. It raises an interesting question. That information was fairly obvious and intuitive from the beginning of the process, and that data was available for some time. And so then the question arises: what actually is going on in certain firms? I think it varies by industry, but it also varies by firm. How people are dealing with the inherent uncertainty of the situation. I think in some places you have potentially a disconnect between the deal team and the investment committee. The deal team's being told to stay out there and look at stuff, and they bring something, get it reasonably ready for market, and then you get reticence on the part of higher up. So I think there's a fair, and I see that on the lender side as well. I'm sure we'll talk about that at a different point, but it's fairly anecdotal both by industry and by firm. There's a lot of uncertainty there, and it's very hard for some people, I think, to get their heads around.
Yeah, and I think you bring up a good point about the lender as well, and also particular firms, what's going on. I mean, firms that, have more trouble in their portfolio probably have their heads down a little bit. And certainly a lot of companies are suffering and creating, more of a time suck for deal teams inside of the firms. But, these processes don't really, the gasoline they need, it comes from the lenders. Without the lenders in this in an M&A process, it's hard to get a lot of deals done. So James, let me jump to you for a moment. What are you seeing, with the lenders, and how best could bankers and funds work with their lenders, particularly the senior lenders, which may have issues in their portfolio, to overcome those to get them to still participate in a process like this?
Well, I think what we talked about is obviously it's sector and deal specific, but I feel that you got to really dig very deep into the lenders and understand their portfolio to what those problems are, because they have the same problem. They want to look at deals. They have the marketing people out there, but risk and credit committee people might have a mandate of no loans right now, especially no new business with people that don't know. The way that we're going to get lenders back, senior lenders back, is to let them feel that, they're not participating with the rest of the market. So you're going to have to dig a little deeper to have a broader process, which is what we do when we do stapled financings, to have 3, 4, 5 different lenders that are showing interest to see who's going to start moving. If they think they're the only lender in there and they really can't do it, they might string us along a little too long and waste time. But I just don't think until they know what's in their portfolio. So I think this quarter is a big test for them to see what's in default, what's not, who got liquidity, and then they're going to reassess things. And I think there'll be, the big lenders are, have got real estate portfolios that are another factor that isn't coming into this yet. So these are all things that are sort of moving around, but I agree that this is the gasoline to get a lot of our deals done. Mm-hmm. And without a strong senior lender market, the only people that will get deals done is funds that are larger that can write a full check, or you're gonna have alternative debt funds that must partner on deals 100% to get the deal done.
So, over the last 2 months, most of our interaction with lenders has been over the PPP loans. And so many lenders, including some of the largest lenders, have told us, we're actually just too busy to talk about anything but PPP loans. And now, it's going to be the new Main Street loan programs that's going to soon become occupying their time. And we found that was taking away from some of the M&A focus sort of the response we were getting is, look, we don't even have time to think about M&A. We've got all this other work that we have to do, and it wasn't even in the distressed area. But Peter, let me ask you, what have you seen in terms of the senior lenders, and how have they been behaving? What's your experience been?
I'd say for us, we're in a, kind of a situation where the things that we're looking at currently that we're most excited about have actually been on the smaller side. So, we focus, call it 3 to 15 of EBITDA. A lot of the things that, we're most excited about now are, call it 3 to 6. And in those situations, we've got the flexibility to, do the mezz and the equity. So, we're actually thinking of just kind of overfunding and ignoring the senior lender, component of that at the current time, and then using that for, kind of the acquisition capital for a buy and build strategy. So, our relationships are telling us that they're open for business, but I'm, similar to James' comment, I'm a little bit skeptical. And that I think that they're, the business development are doing what they should be doing, saying we're open for business. But, when you get something to a credit committee, are they really going to be willing to fund? I don't know. So, we're trying to take that, kind of risk out of the equation when we're talking to prospective buyers. And, consequently, a lot of the things that would probably be larger that we'd like to pursue, we're probably not being as aggressive on just because we can't write that full check.
Yeah, I think, and I'm curious if any, David or Scott, if you have views on what you've been seeing as well in terms of any lender activity or not.
Absolutely. I mean, I think, from my window, and I think everybody's got a fairly unique window depending on the companies that they work with, but the first several months after COVID was really kind of triage, just working on your segment of the overall portfolio, working with our head of risk, Phil Daniele, who's a great guy and has really done a great job, prioritizing the businesses that need the most help the soonest. And, really the first 2 months or so was making sure that those businesses were addressed. Really kind of in some cases, just getting them through the next couple months, so until we can figure out a longer term solution, see what actually transpires, et cetera. And that's a serious process. It takes a lot of time because you're dealing with the entrepreneur and or the private equity firm, but in many cases you're also dealing with other lenders, which, as is discussed, it's a real soup right now in terms of who's open for business, who's running scared, I would say that the first couple of weeks, at least, it seemed like there were some lenders that were basically in paralysis and unable to make decisions, making sort of off market, whatever market is, requests for amendments and things of that nature. On top of that, as you mentioned, the PPP, I mean, we gave amendments to virtually every portfolio company to allow for the PPP proactively so that they could, not worry about it. And I think after you got through that process, and it's starting now, I think that a lot of the companies that that were worst hit are now coming back. You got a couple months of projections, a couple months of historicals under COVID, and people are trying to start to project, and many are coming back for longer term solutions. And that's going to be really challenging in the current environment because there's still a ton of uncertainty. And so it's very, different lenders are open-minded, and others are, I think, still in flux. And it really is lender by lender. One of the earlier comments about, working with several lenders, I think it's very important in the M&A process right now to establish your coalition of the willing, really figure out who's open for business, who's really looking to do deals. And if you're confident in that, bring those folks in early. And that way you don't end up with a whole separate process that takes on a life of its own with regard to the financing.
Yeah, well, I would just say to piggyback on that, one, to clarify my earlier comment of business as usual, I think that's pretty focused on the high growth fintech companies that I work with and the businesses that aren't terribly affected. On the merchant banking side, we're involved in a consumer facing roll up that we've seen some, to your point, we were trying to make some acquisitions, and we called our bankers, and they were like, "Ha, you think you're going to get M&A financing right now? Like we're up to our eyeballs with PPP loans," and they said, "You guys are just nuts that you think you're going to get that." That being said, we're very well capitalized, So we've just been buying things for 100% equity, and we'll just figure it out later. And some of the opportunities that we've seen, like these are retail storefronts. We picked up 6 retail storefronts in Austin for 0.3 times 2019 EBITDA. So, and we're taking over the Seattle market for 2 times 2019 EBITDA. And these are things that would have been 5.5 or 6 times deals. And so it's actually worked out quite well if you have a good balance sheet or are willing to kind of lean in and do it full equity. There's plenty of opportunity out there, but yeah, there's definitely some distressed situations.
I think you're absolutely right. And, if cash is king right now, it always, in these circumstances, it always is. But, the deal I was talking about earlier where there was a sudden pause, the deal was arguably better, in the proposed form, call it 3 times leverage, 50% LTV, equity guy writing a big check, but it was still pricing at least 200 basis points above where it had originally settled last year when we did the original deal. So there's uncertainty, but that's a 3 times levered deal. Getting a 200 basis point bump gives you an idea of and that was just us trying to clear the market because we needed syndication partners to get the deal done. So if you have the cash to equity overfund, as several of you guys have said, and are confident in your ability to refi it when things normalize, you will save money overall, I think. That's my guess.
And we're coming off of, a market that was so overinflated in terms of, debt terms, right? Pricing was down, covenants were barely, banks were falling all over themselves to throw money at deals. And there's been, they've been throwing themselves at the PPP loans, but, David, as you said, not so much on M&A. But let's pivot a little bit. Let's go, because you all have brought up some of the interesting deal terms you've all been seeing. David, back to you, because you mentioned multiples. You commented that in Austin and Seattle, you had seen some very favorable multiples. What is your general sense is going on with multiples and valuations in this market?
Sure. So for unaffected businesses or businesses that benefit, you're seeing an inflation of multiples. So for high growth tech companies, look, we're like mid-single digit percentages off highs on the public markets, and it's just hard for a buyer to come and look at a high growth tech company that's profitable, that their customers are still paying, like if you're in the SaaS space, and say, hey, we deserve a discount. I think those discounted multiples that we're seeing is, again, it's retail and guys who don't have quite as good of access to capital as we do. So yeah, we've seen if you're a mom and pop, like those stores that we're picking up for 0.3 times retail on the merchant banking front, that's a mom and pop guy that said, oh, forget it, I'm done. Like, I just don't want to deal with this. And they throw the keys back to the lender, and the lender says, hey, you want to take them over, pay the transfer taxes, and you can have them. And we say, great. But, and we're seeing it, but, our lenders in that venture, as soon as COVID started, reached out to us and say, hey, you guys want to go pick? Like, you don't need to pay interest anymore. And it's like, okay, cool. Yeah. So we've been cash flow positive throughout this whole thing because our lenders reached out to us. We didn't reach out to them. And they said, hey, if you're struggling, let's go pick. And we're out, buying. And I think there's definitely going to be substantial impact, but the public market is not really showing that. And particularly, if the market if we're single digit percentages off and you see a EBITDA down 20%, that means that multiples are up fairly substantially. And so in the private market, I think it's kind of the same for those high growth tech companies that we look at. There's no retrading. It's business as usual, but people are just paying full multiples and are reaching out and looking for those opportunities. But again, I think that comment is probably limited to the scope of folks that are high growth, pretty much fully equity financed. There's not a bunch of debt on them. Their customers are thriving. Their business critical software, so on and so forth.
Well, you bring up a point about the small mom and pop shop that's been closed for a while, and the owners just say we're done, here are the keys. But James, let me ask you a question. when you have companies that have been shut down for the last couple of months, let's say a fitness company or a gym or something like that, that's, 30, 40, 50, 60 store chain, for example. How do you value companies that have been shut down? I mean, do you look at, do you just go back to 2019 and plug their numbers and pro forma them? And what have you been seeing?
Well, I think it's not sort of set in stone yet how we're going to go do this. So it's a little bit of an unknown. You're going to need, in our view, a couple of months of track record to see how they're bouncing back. It's going to be really unique based on their market. If they don't have enough money to go do this, it's going to be a lot longer stretch. Probably the valuation is going to need some sort of catalyst for them to sort of, get back to where they were. Now, if they've been doing well and it just completely shut their business because the state shut it and they come right back, let's say they have contracts, we have a transportation company we're marketing, and once the contracts are back in place, they should immediately go back to the same daily value and volume. That could be different. And we're going to have to also put a structure in place that's still unknown, and probably the market will determine 2 or 3 that work for what to happen if there is another shutdown and if this reemerges in the winter, or the business fundamentally changes in a new normal world. And that hasn't been determined either, but there's going to have to be some sort of sharing, either on upside or downside, to make this fair. And it's going to be, when you have private companies and family-run companies, which we sell for years, they're not sure ever of the process anyway. And now they have to deal with this. It's going to be, a lot of hand-holding and a lot of sort of figuring things out, but there's going to have to be some leap of faith on both the buyer and the seller to get a transaction done. But, the seller doesn't want any discount. The buyer wants something that's fair. We're going to have to meet in the middle somehow and work it out, but it's going to be over time. That's all I can
It always takes longer for seller expectations to come down. Like the buyer always moves first, and the seller, it just always takes time. And when valuations come down, you're always going to see this deal flow slow, just because the seller goes, wait a minute, a month ago it was worth $50 million. Why are you showing me 35? And it's like, hey pal, it's changed. And it just takes like a little bit of time and for them to actually digest and swallow that difficult pill.
That's right.
I think, particularly when you're talking about fitness or, some of these, a franchise business, fitness in particular, I think is, there's a real question as to what the unit volume is going to be now. If you had something doing $500,000-$600,000 of revenue a month pre-COVID, what are the expectations for getting back to that kind of level? I just don't know. So you've got for some businesses, there are fundamental P&L and unit value questions that have yet to be answered, and there's really no way to get to that other than you can discount past results or see how things develop.
We've been shocked for the operating results for these. It's a restaurant franchisee roll up, and this extra $600 a month has had such a crazy impact, because $600 a week, that's $32,000 a year, and you add that on top of they were already getting $300, $400, $500 a week. So you have people who are approaching $50,000 a year, and that's done 2 things. One is we're seeing positive comps for drive-throughs, which is insane when you think about what's going on in the world. And you're also seeing you can't hire, because you tell a guy, hey, we're going to pay you $15 an hour to 2,000 hour work year. That's 30 grand. And he goes, I'm making 45 to sit at home and do nothing. So it's very interesting, but I agree. Fitness, it's hard to see that coming back full freight, because there is some portion of the population that's scared. And also, like, I live in Manhattan, and this idea of, it sounds good at first blush of like, oh, we'll half capacity reopen restaurants. It's like, okay, that's half-baked, that your rent is the bulk of your cost, and the restaurant business, as everyone knows, is like a 10% margin business if you're lucky. And so you're going to tell people that they have to cut their revenue in half, like, and then what happens? Yeah, sure, you can slim down a bit your service, and like your cost of goods sold goes down linearly, but you're not going to be able to cover your electricity, your rent, all those fixed costs. And so I couldn't agree more that it's just a half-baked idea. And in those sectors, I do expect to see some fairly meaningful distress run through over the coming 6, 9, 12 months.
Well, one piece of good news I'll share is I work with a particular fitness studio. There are about 75, 80 locations in about 15 states. And in those states where they've reopened, volumes have come right back, have literally sprung back. So that's been very good to see. You know, they're still closed, however, in a number of restrictions, but at least the ones they've reopened, we've had a good recovery. So
some folks are for sure exhausted by social distancing and have just hit their point where they're just like,
right.
I don't care. And by the way, the virus is also very clearly respiratory, so it's age and weight dependent. And like I have the antibodies, I barely even noticed having the virus, but I'm 30 in my early 30s and very healthy. I work out all the time. And so it's just not a big deal. So my friends and the people I socialize with are out at bars in Palm Beach, and which is reopened, and they're like, they want to get back. And so that doesn't surprise me that something like a Barry's Boot Camp or a high-end studio is going to see this young, healthy crowd say, open it back up. I've gained weight since being home alone. I want back in.
Or I've been cooped up. I just need to get out.
Yeah, right. Blow off steam. Exactly.
Exactly. So projections. Let's turn to projections. What do folks think? You know, when you get a set of projections now, and you know they're going into the rest of this year and out in 21. How do you all look at them? Scott, why don't you start with that, and then we'll pass that question around.
Yeah, you know, it varies a lot by industry. You know, for example, the manufacturing company that I referenced earlier, you end up going customer by customer through the pipeline as well as through receivables, and you question timing. You know, for most of the, you know, if it's a government customer or something like that, chances are they're going to come through, but they may not pay you on time, so you have a working capital issue, things of that nature. When you get to gyms or restaurants, you know, if it's very hard to understand what unit volume is going to be. If you're starting to see positive comps within COVID, I think that's a huge advantage. Any company that's like weathering the storm right now, I think is going to do very well in the market. But for example, I mean, we work with a company that buses kids to school. You know, the revenue is zero. Right. You know, but you can look at the contracts and you can say, all right, these are the company's contracts. The company has cut costs, you know, very significantly, and assuming schools open in September, still going to need to bus kids there, you know, to some degree. Maybe have less buses on the road. So I think it really, really varies very specifically on the business, but you got to dig into projections because you, as always, you're going to have some people saying, cut it by 10% and raise it by 5% 2 years out, and that's just not going to fly right now. It's got to be granular. You have to understand the end customer, and I think you have to have a theory behind what you're investing in, rather than just sort of up and to the right. That cannot happen now, I think.
Well, right. You always need a theory, right? You always need a theory behind your projections, and I guess it's so hard today to be able to put a theory behind how you support what Q3 and Q4 are going to look like, and Q1 and Q2, right? So.
I think it's also helpful for buyers, if the very thoughtful buyers, I think, are looking at various scenarios of possible ways that it plays out. Like my point on the restaurants seeing positive comps, that's kind of strange and weird, but there's definitely like management of these large companies that, like the franchisors, are reaching out to government officials and saying, hey man, I can't hire anybody. You got to not redo this $600 a month thing because it has unintended consequences. And so what does that look like? What do you think your assumptions, you can model out with various different ways. Like, what does it look like if that 600 goes to 300? What does that look like if the 600 goes to 0? What does it look, you know, there's various scenarios, and we just don't know. There's a ton of stroke of the pen wrist. What does it look like if people fully open back up? What does it look like if there's another shutdown? And just kind of thinking through those various scenarios, I think, can help you build confidence in order to submit a comfortable bid. But there are definitely the banking clients that I deal with primarily are just not really seeing an impact to their business, and as such, their projections are the same.
So let's pivot to deal structures. We have a question from the audience, which we'll work in here. But Peter, let's talk about what's going on in terms of structural elements of the deals. What are you seeing out there, and how has COVID affected? And this will go into the question from the audience. Are we seeing more earnouts? Are we seeing more downside protection? What can you share with us?
I think, as we kind of look at, the opportunities that we're pursuing, I think it kind of gets back to the earlier, the last discussion we were having is, kind of what level of confidence can you get, and what are the trends telling you about performance in the second half of the year? And I think everybody understands that, there's going to be a hole for a lot of companies in the second quarter of 2020, right? But the question is, what's the new normal, coming out of that, kind of going forward, and how do you, to James' point earlier, come up with a structure that kind of provides, execution risks for the buyer today, but long-term protection to the seller in terms of, selling, at too cheap a price, longer term. So, we've got one deal that we're working on now that was a pre-COVID, it's a, small PEO, which, PEOs are working with the SMEs, right? The very small companies, they're obviously impacted. And, we've, kind of looked at that one, and that's one where the seller was reinvesting a fair amount. We've asked him to reinvest, even a higher amount, and, shifted some of the cash into an earnout, and said, over time, we should kind of get back to the normal. There's the opportunity for this to potentially be an impetus for growth as, small companies, struggled and kind of accessing PPP and other things like that. So they look at it as a way to protect themselves in the future. Another thing that we've been contemplating is, kind of a scaling, kind of equity that either based on an earnout or based on, our performance at the end of the deal. If we otherwise would have acquired 60% of the business normally, we'll acquire 80% now, but the seller has the ability to get it back down to 60 based on certain performance metrics. I think that the challenge in earnouts, as I see it, if I'm the buyer or if I'm the seller, is, what's my confidence that I'm going to get back to a normalized run rate, over what period of time is it going to happen? So if I'm looking at, kind of a normal 1-year earnout structure, do I feel that I'm going to get, full value for that? I don't know, because I just don't know how fast things are going to come back. And, to Scott's point, every industry is a little bit different, but, I think I'd be more comfortable if I was a seller looking at the end game, as opposed to trying to pick an interim point in between to kind of set my marker.
I think that the earnout is very interesting. And we see that we have a large services practice at our firm as well. And so earnouts are typical throughout all parts of the cycle and multi-year earnouts in order to keep the management around and engaged. And at the core, it's an interesting way of bridging the gap of seller and buyer expectations. Because the core, the people who are selling these businesses and the primary owners are entrepreneurs who are inherently bullish and optimistic. And if you show them a deal that's 10 million of cash up front and 10 million of earnout, they go home to their wife and say, I just sold my business for $20 million. And they go to the golf course and they tell their buddies they sold it for 20 million bucks. And I think it's an interesting way to bridge that gap, because when you're dealing with these entrepreneurs, none of these guys, every single one of them tells you that their assumptions are conservative and they'll rip it through the park. And by the way, after they sell this business for 20, they're going to go start a new one and they're going to sell that, and they're going to call me in 5 years and that one's going to be $1 billion. So this one, something weird went wrong, so I think that is a really good way in order to bridge that gap and tell the entrepreneur, yeah, you're getting 20 million bucks, when really in the back of my mind, I'm thinking there's a reasonable chance that you're not getting 20 million bucks because things are impacted.
I think it also varies on the age of the party that's selling. Again, if they're older, the issue of time is a problem. If they're younger, they can deal with it. But I'm thinking that we got to think about the label of what this is compared to a typical earnout, because things are different. It's got to be explained why the tenure has to be extended a little bit more. I think 1 year earnout is too risky on both parties. And I feel it's hard to pick the date and the time. And, we'd all like to have things more fluid over longer period. But there's got to be something that the market sort of steps up and say, well, this is a little bit different, but we think it's protecting both parties, but we're going to get the deal done. There's definitely a fear with entrepreneurs that they just can't go through this again. If they survived the financial crisis in 2008, now they have this, what's next year or the year after? So having a partner is a very compelling process right now, once they sort of get back to some sort of normality. But I also feel like it's got to be we addressing the issue very early on in the structure is the key to getting their interest to, you know, fulfill a deal that might take 6 months because we have to keep on monitoring that company through the rest of the year.
Yeah, and I know Peter, what you had mentioned before about sort of the clawback construct, you know, we're seeing a deal right or a potential deal right now where that was a pre-COVID marketing process stalled in the midst of COVID is now resurrected with a couple of the bidders looking to, instead of buy control of the business, come in at 20 or 30%, do an equity recap, but then also get a call option on another 50 or so percent with a floor price on the call option and a short, you know, 12, 18, 24 month term. This way it gives, gives them the opportunity to have downside protection. So they're not making the big bite today, allows them to see how the business is performing. And, you know, it's all about the floor price, right? And how that's struck. But that's, that is a new, we've done that many times before, but I think it's a tool that's being used to address sort of the uncertainty. So I know one of the questions from the group, from the audience was, you know, are there other types of structures that folks have seen? So I throw that out if anybody has anything else to share on that point.
I've seen a couple of people. It seems like there's a little more minority deal flow than I've typically seen. You know, from a buyer perspective, you know, you like the business, you maybe under ordinary circumstances would take the whole deal, but under the current circumstance, you take a minority portion with significant shareholder rights, that kind of thing. And on the other side, I have seen several deals where folks are looking for a minority equity partner. I think perhaps, you know, in response to some of the comments that were made earlier, where you don't want to deal with senior banks right now. You don't want to give up the entire business, but you need help. You know, we had one deal, great business, had some minor issues last year, just, you know, integration of acquisitions, et cetera, but overall a very healthy business. And they went and did a deal with a sponsor 2 months ago. We rolled along with the deal. But from a value perspective, it was a significant haircut, but they did a minority deal, which I think helped the entrepreneur and the legacy equity holders get their arms around it. They felt like they needed the management help, particularly now, and a lot of the sort of bells and whistles that this private equity firm brought to the table. And so they decided to make a move, but on a minority basis, which I think got them more comfortable with it.
So let's talk, we have one more question from the audience I want to try and work in here. Says that a large PE fund recently asked if a company was located in New York or California, or if the majority of revenues came from clients in New York or California. They indicated that they were presently unable to determine the new politically driven closure risk and were therefore avoiding deals in that geography. Has anybody heard sort of anything similar to that among the panel?
I've heard the opposite from the lending world, that is sort of redlining sort of hotspots, and they're doing some ranking internally. And if that's a vulnerability for a longer period, they're trying to figure out what to do with those loans that might be more susceptible compared to other areas. But I haven't heard it on the buy side yet.
Well,
I haven't heard it on my end, but, you know, I think that, you know, a lot of that comes down, you know, the PEO is a good example. Is, you kind of dig into each of their customers and understand what type of business they are and kind of where they're located to determine kind of what type of risk you think is out there in the customer base. So, you know, we would be doing that analysis, you know, regardless. But, you know, I don't think that we've, you know, come to a firm conclusion that, you know, we would just, you know, not do a deal in those markets because of it. It would depend on the company and the dynamics.
Right. I haven't heard it articulated that way, but everyone's going to peel back the layers of the onion of like the financials. And if you're in a place that's a hotspot that's closed down, you're going to see the impact on the numbers, and thus it's an impact. But I've never heard someone articulate like, I'm not anything hotspot related, I don't want to go into, and so on and so forth.
Yeah, same here. I've not heard I've heard more industry sort of allergy.
Of
right.
course,
I don't want to go into, I'm not buying a XYZ type business today. I'd love a grocery store, but not,
Not a mall.
Right. Not a mall. Not looking for malls or airlines.
Right.
Before we switch to the outlook, because I don't know how much time we have left, but Scott, what are you seeing in terms of changes in legal documentation? Are you noticing anything? I know we all focused on sort of the L Brands lawsuit down in DC, in Delaware, a month or so ago, but anything interesting?
Yeah, I mean, look, the vast majority of the opening up of the docks over the last couple of months has been to provide sort of blanket waivers of sorts for PPP and other government assistance. And for the most part, we've worked in language that basically says, as long as it's forgivable, it's not included in relevant ratios. So if the PPP for some reason becomes a recourse loan, then it becomes debt. Otherwise, it's excluded from relevant ratios rather than going in and recalculating everything. There is obviously a lot of clamor for COVID-related add backs to EBITDA. Some of those make sense, some of them don't. Proof is in the pudding there. You sometimes get companies trying to throw everything, including the kitchen sink, into a COVID add back, and it may not be appropriate. People trying to stretch, get out of their excess cash flow payments, in some sort of documentary fashion. We don't really want to do that. If there's a reason why you can't pay the excess cash flow payment, let's talk about it and waive it, as opposed to sort of messing with the language. So I haven't seen anything sort of huge structurally changing. It's really been more around terms and language in order to get things done in an efficient manner.
I'd say on our side, there's two things that come to mind. One is the MAE clause is now definitively allocating risk of COVID on one party or the other, and that's a negotiated point who's taking it, but it very clearly spells out, whether a pandemic or the effects of a pandemic are in or out. And the other thing that we're seeing a lot come up, and I think we're going to see this for some time to come, is compliance with SBA rules if you took a PPP loan. As we've all read the news about, the Shake Shacks of the world, there's a lot, anybody who took a PPP loan is going to need to make a certification that if the government comes after them, I think a buyer is going to want indemnification. So let's go to the outlook, and I guess Peter, I'll go to you in terms of if you, before the news media changed topics, and while they were still covering COVID, which they don't seem to be doing as much anymore, we were talking about the backside of the curve. Do you feel like we're on the back end or backside of the curve in terms of deal flow and M&A processes, or people picking their heads up now? Is it mostly behind us and there's been an uptick, or what do you see?
I'd say for us, kind of the incoming flow, there has been a marked improvement over the last, 2 to 3 weeks. Is it, fully because of, kind of we're on the downside of the curve? I think that kind of depends on kind of region of the country. Clearly, being in the New York area, you don't feel like we've come out of anything yet. We were at a restaurant the other night and there was like one other table that, had somebody there, because you can only sit outside and they can only have 4 tables to begin with, type of thing. But we are seeing, kind of an inflow of, kind of deals that, for the most part, I would say have had some impact. So it's not like they've just, flown through kind of the last 3 months without, any any degradation of business. I think that they've been impacted, but probably not significant. So they can kind of look out there and show the right kind of trends, and data says that they're kind of back on kind of their pre-COVID kind of pacing, if you will. But we're April, May, we were getting 1, 2, 3 deals in a week. I think this past week we got close to 15. So there definitely has been a pickup from the community to kind of get back out into the market.
And I guess, James, what are you seeing in terms, once, I spend a lot of time, I also work at our local hospital, and one of the interesting things, dynamics we saw is a lot of people were not coming into the hospital who ordinarily would go in when they're sick, because everybody was afraid of going to the doctor or going near, a facility that had a lot of COVID. So the huge backlog built up. And the same thing feels like it's happening in M&A, that there's just a tremendous amount of backlog building up. Once that backlog, once the logjam breaks, what do you think the world is going to look like?
Well, I'm taking a more cautious view. I think there's bankers and deals that are floating around, but I don't think they're doable. I think there's going to be a window that's going to open, hopefully sometime in September, maybe into early October, when we get some results that are real and there's some benchmarks. But this is going to get down to a lot of information that companies are going to have to provide to get people comfortable. And I think expertise, wherever it comes from, is going to be highly valuable to figure out that the company is actually projecting and saying what's really happening. And I think that's the information problem. So my view is things will sort of chug along. People want to have conversations. People want to show that they're busy. But I still think there's a lot of hesitation to do too much. And again, if you can't get a senior lender in there for at least 2 or 3 months, you got to take that in consideration. We don't want deals sort of dragging on. So it's sort of a tightrope, I think, right now. But I don't think it's going to nothing's going to open the floodgates right now. We've got 4 deals on pause, and they'll probably stay on pause at least for another 60 days.
Especially given that we're heading into the summer, which is which is seasonally slow time for M&A activity. Well, look, I think we're coming up on our time here. So I don't know if anybody has any parting comments, but we've answered the questions that the audience has shared with us. And I'd like to thank everybody for participating, and the panel for your great thoughts. Certainly your experience in what you're seeing. But if anybody else has any questions or any parting comments, please.
Thanks so much, Steve. Really appreciate the opportunity to be on the panel.
Great.
Likewise. Thanks, everyone.
Thank you,
I want to
Steve.
thank you all.
Good.
Thank you all for participating. Thank you to our sponsors. Thank you to our attendees. If you are participating in the Deal Connect portion, you'll log off here now. There's a separate link to log in for the Deal Connect. We have another webinar tomorrow morning, first time fundraise, what to expect in a COVID-19 world. So tune into that. Until then, stay safe, and we look forward to seeing you all soon. Thanks, everyone.
Thanks all.
Thanks, Lena.